Will be our tax pro, Greg Piccaro, CPA and partner with Artranda Piccaro & Associates. But up first, I want to welcome our very own real estate and mortgage expert, Steve Tetzner, Vice President with Homestar Mortgage. Steve, thanks for being with us back on the show.
Glad to be here.
All right, so we actually got going with this myths idea. There's so many financial myths out there, but you and I were talking about one that sort of inspired the whole show, the idea of financial myths, which is, when talking about mortgages, the idea of the myth of APR. So what is APR? Why is it a myth? And why is it so important for people to understand the reality behind it?
Well, the APR stands for the annual percentage rate on a loan. The annual percentage rate is supposed to be the effective rate that a borrower is paying to borrow the money. So very often we'll get consumers who will ask me, well, what's the APR on that loan? And I have to explain to them that the APR really isn't relevant. It's not something that you can take from one lender to another to apply to figure out what is the better deal for the loan. The APR is basically taking all the costs associated with obtaining the loan. If there are points, the legal fees, per diem interest, certain things that get factored into it. But it's an imperfect system because the way the government regulated the APR, they were very vague about how the APR should be calculated, exactly what fees go into the APR. So you could have one lender that calculates the APR one way and another that does it a different way. So the very same loan with the same rate and the same fees could actually have different APRs. Where the APR is very good, though, is when you see advertising, when a rate is advertised on the radio or on TV or in print, and you'll see an interest rate that's often what we call a teaser rate, where you might see a 2.5% interest rate, but the APR is 3.1. When you see a huge disparity between the actual note rate and the APR, that's a signal to the consumer that there are probably a lot of fees associated with that loan, so you should be careful. But when you're making an actual comparison between which lender to choose to work with, you have to go a lot deeper than just the APR.
And just so quickly, what are some of the things, if you've got to go deeper than the APR, off the top of your head, what are a couple of things that borrowers should really be looking at beyond that rate?
Well, the most important thing you want to look at is what is the note rate? And that's the rate that is actually costing you to borrow the money. And then what are the fees that are associated? So what is that lender charging for fees? Are there any points associated with the loan? Do they have origination fees? What does that entail? Processing fees, underwriting fees, document preparation. How much do they charge for the appraisal? How much are the legal services associated with that lender? How do they conduct their business? That's probably one of the most important things to look at.
So it's not just about jumping on the phone, calling 10 lenders and asking what's your rate on a 30-year fixed mortgage.
Absolutely not.
Let me move on to another topic now. We've seen the pendulum swing quite a bit from, say, 5-6 years ago, where the joke was anybody could get a loan, I guess, if they had a pulse. The pendulum certainly swung in the other direction with the real estate crisis and things like that. But a lot of people now are under the impression that you need perfect credit to get any kind of real estate loan. Is that true? Very untrue.
Very untrue. I mean, you need fair credit. And then there can be situations that you may have run into a personal situation because of a divorce or a situation because of your health, that we can account for that. And there are compensating factors to credit report. You know, if you have absolutely horrible credit and you just don't pay your bills on time, you're not going to
get a loan.
Probably not.
But if there are extenuating circumstances, lenders are willing to listen to that and you have a chance of getting a loan?
In very many cases, if it's a legitimate excuse, yes. And then it may be a period of time where they may say, well, come back in just 6 months. Show me 6 months that you've paid on time, or 12 months, and we'll give you a mortgage.
So people shouldn't despair if they don't have that 750, 800 credit score.
Absolutely not.
Certainly a loan available potentially for them, particularly if there are extenuating circumstances.
Down to FICO scores probably as low as 600.
Okay. Now, another piece of that is, say 5 or 6 years ago, you could get a mortgage without putting any kind of money down. Again, a situation where the pendulum is swung, lenders are looking for more skin in the game. But is it true you need 20% down for a real estate loan?
Actually, there's still first-time homebuyer programs available with no money down. There's VA mortgages available with no money down, USDA mortgages available with no money down, and then there are FHA loans that are available to all buyers up to certain loan amounts that are available with as little as 3.5% down.
So again, don't despair. If you don't have 20% of the purchase price, it doesn't necessarily mean you can't get financing. Last one, and this one kind of piqued my curiosity because when we were talking about it, I didn't really even understand it, so I'm hoping you can clarify things.
Okay.
You get a mortgage from the bank, whatever that bank or lender might be. People are under the impression that they're borrowing money from that bank. If it's, I don't know, Bank America or whatever the lender is. Are you saying that's not actually the case?
In most cases, it isn't. If you're getting a fixed rate mortgage, a conventional fixed rate mortgage, loan amount $417,000 or under, that loan is probably being resold in the secondary market to either Fannie Mae or Freddie Mac. The majority of those loans are held by Fannie and Freddie. Banks cannot hold long-term fixed rates in their portfolio and lend out their own money. They would be exposed to interest rate risk. If you remember back to the late 80s and early 90s, we had all the thrifts that went out of business, and that's what they were doing. They were lending fixed rate money, and then when interest rates went up, the interest rates and the loans that they had in their portfolio were lower than the interest rates they had to pay to their people that were putting money into their savings accounts. So they were upside down.
I'm going to have to hold you there, but no shortage of myths, even some of the ones that I'm susceptible to.